Jones, what format do you want?
I am in your living room. You tell me what you want me to do. I'm a motor mouth, so you know I won't be shy of
Yeah,
talking.
I always show up half prepared. I read about stuff and then have 100 charts, and then I don't know how to pick. Brett reads his Wall Street Journal very meticulously. He pulls his charts, has the article. It's just different styles. And again, you're not going to have any issues finding words. So
Yeah, if you
Right.
don't know what to talk about, you just move on to the next chart and you just say, okay, thank you. Moving on.
yeah, when the first rule of talk your chart, don't confuse yourself with your chart.
Don't confuse yourself. I would think we would be confusing the listener, not the
Yeah, no,
not the
this is yeah.
They'll
This is
just
a good
assume it's
outtake.
them.
This
They'll
is a good
assume it's
outtake.
them, not you. So you'll be okay.
right.
They'll say, man, those guys are really smart. I didn't even know what they were talking about, but they seem like
Wow.
they know what they're talking about.
How confused am I? Oh God, they're so
Right.
freaking smart.
I need a financial advisor. I don't know what I'm doing.
That's right.
Okay, so do you want this chart, Jones?
Yeah, like what no, you know what? I'll just use the stats. I don't need the chart. I'll just use the stats. I'll just be the guest. I'm the Muppet sitting up in the balcony, just hurling one-liners and
All right, welcome to episode number 63 of Talk Your Chart with today's special guest and our dear Chief Investment Officer, Lane Jones. Lane, thank you for joining us today.
thank you for having me. I will do my best to keep up.
This is a pleasure for our viewers and a pleasure for us. And let's waste no time. Brett, you have the honor of today's first chart. Please lead the
I,
way.
I'm excited because not only are my parents watching it, but Lane, your parents will be watching this as well. So there'll be more viewers watching these charts. And I'm excited that the first chart we're leading off with talks about gross fixed capital formation, which doesn't mean a lot to a lot of people. But what we're talking about here is basically investment, a broad measure of investment. The US has been dominating this in the last 10 years. So a couple of stats for you, which I was not aware of. So the US, in terms of GDP, has grown 2.7% in the last year. That is outrunning every other major developed country, not to mention its own historical growth rate. None of the other world's next six largest advanced economies grew more than 1%. So we're dominating there. Um, in fact, no European company worth over $100 billion euros has been created in the last 50 years, whereas there were six U.S. companies worth over $1 trillion been created over the last 6 years.
Hello.
So they always say that you don't, in order to feel good, sometimes it's better to look at your next door, your neighbors. We should feel pretty good about ourselves. Thoughts?
I agree with you on that. I think there's a lot of reasons you can probably point to in here, but there's no question that reinvesting in growth is something that drives future growth. And, I mean, there are arguments in here about, tax rates and the economic system that the United States has developed, which encourages innovation and capital formation and all these other things, which is somewhat of a subject of a slide we'll probably look at in a second. But yeah, the growth in the world is certainly manifesting in the United States, and it does talk a lot about some of these cyclical or maybe long-term structural things that are out there, the AI boom and all the rest. But yeah, future growth is born in current sacrifice in terms of these are dollars that could have gone to investors, right? Like they could have been spit out in dividends, and instead capital formation and capital growth, reinvesting in businesses is done. It also has a lot to do with the fact that this system has a lot of confidence, which is that if you are going to take money today and invest it for the future, it's because you have somewhat of an optimistic view of the economy here and the system and the rule of law and all these other things that make the United States and capitalism here so effective. So I like this chart, and it actually bodes well for manifesting growth out into the future.
It does. Jones, the simple man that I am, this is kind of a side question, so I dare you to try to answer this one in 5 sentences or less. Why own anything outside of the U.S.?
Well, look, there's a lot of reasons why. A third of the capitalization of the world stock market is outside of the United States. So, I often say, don't just own A to M. Why not own A to Z? Truth is these days it's probably A to P. Like there's a lot more in the United States than perhaps it used to be because there's been so much growth in the stock market. But look, we could have had this exact same conversation on Japan at the end of the 80s. Like, why own anything other than that? And then the yen depreciated and the Nikkei collapsed. So you can't talk, when we talk about diversification, you can't talk about any single market because markets can go down and stay down. The NASDAQ, for goodness sakes, went down from the 2000 bubble period. It took a long time to get even back to even. So like entire markets, entire countries can certainly go through prolonged challenges that you don't see coming, as in maybe you would have said in Japan in the late 80s. But it's ultimately the global capitalist system is what you want to own, and that involves the whole system, not just a portion of it.
Okay. Yeah, it becomes harder and harder to have the conviction just because of the performance. But I think academically, I unfortunately have to agree with you. What is you brought a chart to complement Brett's. What's cooking?
Yeah, I mean, look, the chart is basically talking about the size of the pie that is in capital formation, which is, like one of the big developments of the last decade, maybe even 2 decades, but certainly the last decade or even 5 years for our type of our clients, right? As opposed to big institutions, is that the number of publicly traded stocks is shrinking, 6,000 companies down to 3,000. We know this largely because obviously the numbers are there, but the regulation and there's just a lot more of a pain in the rear end to be a public company. But one of the big developments that has happened is that the private equity capital formation machine has really, really matured and has gotten very, very good at growing companies that previously might have gone public earlier, growing them while private and taking them public later, which that basically says that the value that the public markets can extract shrinks because a lot of it is being handled in the hands of private equity firms, right?
Yep.
So this chart I would only take really two things from this. If you look at 2008, the amount of private equity invested assets was, maybe $500 billion, slightly higher. And maybe there was another $500 billion sort of sitting on the sidelines waiting to make investments. That number is now 6 times. It's now $3.5 trillion that's invested in private equity business, in private equity firms, with another 1.6 sitting on deck, dry powder. This is exactly what Brett's chart is showing, that capital investment, these private equity firms that are these machines of capitalism, the gears, there's lots of oil and gas in not only put in place to create future growth, but on deck to create more in the future. So having a healthy capitalist system, and which the private equity firms are really becoming very, very good at, bodes very, very well for the future. And it has some implications for sort of how you think about investing in the future, because now this is perhaps a segment of investing that you have to have a piece of if you're trying to be a diversified, complete investment set.
Yeah, but Lane, why do these companies need more money? Aren't there's as you said, there's a lot of money following these companies, trying to chase these companies before they become public, get in on them early. It seems like there's more than enough there. Why do they need money from clients that have $1 million, $2 million, $500,000, whatever it may be?
I think there's just more deal making going on, so therefore there needs to be more gasoline to fuel that mechanism, right? The ultimately these businesses are using that capital to do something productive with it. It's not that they're just paying themselves giant salaries. This is when you add 1 and 1 plus 3, like in other words, you can put two companies together and you can get a better long-term economic outcome out of it. And never, the private equity firms are very good about adding management and thoughtful synergies between other businesses and suppliers and all this sort of stuff. So why do they need more capital? I just think more of capitalism is happening in the pre-public phase, and they've gotten very good at turning something that is 2 into 10.
How do you Go again, Brett.
By firing employees.
They
All
do
right,
have that
well done, Laugh.
reputation. Yes. Yes. Well, that's the cold hand of Adam Smith, right? Maybe not quite, but capitalism
Yeah.
is a cold-hearted business, right?
Brett,
Designed to
Brett
be.
loves that. Brett loves that. In another life, you were just a big private equity VC guy, Brett. You and a can of WD-40, just working through leverage buyouts all day.
Somehow you found a way to get that into the slide. That's great.
I thought about it immediately when Lane said gears. It was so easy. Jones, what about me looking at this chart and saying, well, that smells like a bubble. That's too much going after too little. Um,
I think it's
go.
a reasonable question, right? There's a lot, anytime a lot of capital has been thrown at a segment of investing, it's reasonable to say, well, there's too much money chasing a finite number of opportunities, and therefore, by default, the quality of the opportunities declines. I just think the pie has gotten bigger. Like when we talk about 6,000 companies public, a decade or two ago to 3,000 now, that's 3,000 more businesses that are private, and that's why this market can handle more money.
Okay. So then my last question, and then Brett, if you have one before we jump to our last chart, does this mean that future returns have to be lower?
I would say future returns on classic private equity deals probably come down. And it's not for the reason you think, which is that there's just too much money chasing deals, although that is certainly part of it, right? Like you might have to overpay slightly versus what you paid before.
Yeah.
I think the biggest thing that is impactful in these is that the interest rate environment of the last 20 years was uber low. And now interest rates are higher and therefore leverage costs more, and you can't goose your returns as much as perhaps you previously could. It doesn't mean that they're not still positive, high single digit, mid-teens with leverage kind of returns. I think it probably still is that space, but I think you know me, Marcos, you're exactly like me. I tend to be a skeptic and looking for what can go wrong, and I would not have any illusions that certainly there's a lot of money sloshing around in these private markets.
Okay.
Do you think that public market returns will go down if less companies exist and those companies are doing better on the side?
Yes, and we might have already in fact seen that, which is that if you look at the starting point price earnings ratio valuations to future forward returns, it's got a very direct relationship where the higher your starting point in terms of valuations, the lower you should expect going forward. It's why this Goldman Sachs guy came out not long ago and said we expect 3% returns for the next decade, right? He's just
Shout
doing
out, talk your chart 62.
Yeah.
was it on 62? Okay,
I
good.
am. David Costin's dying to come on the show. He's just dying
He's
to
going to
come on.
refute everything we say, right? Yeah, I do. I would say that the other part of that is that there's still a large amount of public capital sitting around there, and now it has a smaller opportunity set to chase around, and therefore it bids up the price of everything, which we perhaps have already seen, right? That's why multiples are 22 instead of 16 than they used to.
Yeah. But the market still gave you 10% from 1926 to now, and 13% from 2010 to 2020. Yeah.
Well,
It's
So after
unbeatable.
our forward capital market assumptions are probably 7.5 to 8% on U.S. equities, and that's people a lot smarter than us. We survey a lot of very smart economists and think tanks and the like. I would argue that is, not to get on too much attention, I would argue that is because inherently markets are less risky than they used to be. A lot more regulation, a lot more transparency in terms of
Way
data
more access,
and
man. You could,
exactly.
yeah. The ETF, think about it.
The
All right,
Fed, think about the Fed. Right.
before we run out of time, Brett, any more private equity questions before we jump into the beautiful question of home ownership?
I'm still thinking about a Tin Man joke over here, so move on to the next.
Just get the WD-40, man. Lane Jones, no one can buy a house. This chart comes from our friend Torsten Slok at Apollo. The share of first-time home buyers is at a all-time low. Brett already hated this chart when I brought it up. I'm sure he'll tell us why, and then you can go.
Go ahead, Marcos. You want to start with why you think that this is a good chart?
Well, look, I think it's a good chart because it speaks to a point that a lot of people are feeling, where affordability is terrible right now because of rates and because of values. So this isn't the classic housing affordability chart. that you agree with. It's just another way of looking at it. Yes, perhaps a little bit noisy, given that all we're looking at here is first-time home buyers. And no, now you can go ahead and share why you hated it so much.
Yeah, I'm not suggesting that it's wrong, and I'm not suggesting that I'm going to sit there in my house that's already been bought and say, "Gosh, well, it was really easy to buy a house." Yeah, I bought it 15 years ago when it was easier to buy, so I understand that. I also do believe, though, when I talk to young people in the office and around town, a lot of people don't want to buy a house, whether it's now or ever. They want to stay at home as long as they can. They want to rent and not to deal with a house. They see how much money people spend on renovations, on upkeep, on things that can go wrong. They've run through thousands of financial plans where they see all that, as a line item every year in the budget, what needs to get fixed. So I think the number might keep going down, even if interest rates come down, even if property prices come down. That's my thought. It's a
Good.
theory.
Yeah, I think there's a couple, maybe there's a second order effect in here, but I think this is to Marcos's first point. This is a result of higher interest rates. And ultimately that's affordability. The people that, and there's also another wrinkle in here. While this is a percentage of homes sold, the supply of homes on the market is dwindling because people aren't selling their house because they've got a low interest rate and they don't want to buy a new one that gets refinanced at 7% instead of 3 where they were. But ultimately, that interest rate conundrum is why these folks are unable to buy a home. What's really I like, or I think about when I see this is I think that this is a challenge for wealth building for the future generations, which is somebody's home is typically their biggest asset, but it's the way they start building wealth, right? And buying versus renting is a way to do that, and that's how you start building a balance sheet, and ultimately maybe you downsize into retirement and you have that extra equity. But yeah, I don't think this bodes well personally, and I think it could be clearly a short-term problem. I don't buy it, Brett. I don't buy that it's a result of I don't want to live. I don't want to buy a home. There might be some of that. Maybe generationally, they want more experience and less in terms of sort of like being anchored to someplace. But
Well, the
this is
beauty is
unfortunate.
we get to see if that happens, whose theory is correct. Well, as rates come down, if that chart doesn't bump up, then it suggests it's more than just rates, right?
Yeah,
The
well,
housing prices is in there as well, so you obviously can't discount the housing prices. But
that's exactly right. It depends on what happens in prices, right? Taking this to another tangent, this is why inflation is so insipid, right? Inflation benefits asset owners. It hurts people that don't have assets. It raises interest rates. And, like the person that can afford to sell their house and buy another house is often because they've got so much equity in their house that they can just port it from one place to the other, and there isn't a lot of financing going on. But if you didn't have a home before and inflation hits and drives rates up and drives prices up, that's both sides of the inflation argument. It's prices and rates. This is what it does.
well, we'll get to see about our year-end predictions because that's our next episode, Marcos, and see who's right for what inflation did in the stock market. And I saw some early votes. Not looking good for you, buddy.
Thanks, Brett. I appreciate that very much.
You still got a
Lane,
month to make it up. We'll see.
thanks, dude. Walgreens, the 3-year end. Just watch it. Just watch it. Lane, give us a prediction, which you're not prepared for. What is the 10-year Treasury going to be December 31st of 2025?
Goodness. I think there's upside risk to rates. I don't know whether a full year is enough time for that economic output that would put that there, but I'm going to call it. I think people are expecting rates to come down, and maybe you wind up at a 375 10-year at the end of the year. I mean, at the end of next, you're talking about the end of next year, right?
Yeah, end of 25. And we're
I could see us right here. I could see us in the 4.5 range. I could see a little upside. Like the
so
long end, see the interesting thing is not to get too boring. The 10-year is a longer term kind of rate. The longer term outlook is anchored by inflation and less the Fed. And
yep.
I think there's I shouldn't say consensus because this is counter consensus, but there's a real worry that all of the debt and all of the other things could push, maybe the tariffs are more inflationary, all these sort of fears that you've probably already heard about, that there could be upside rate risk on the longer end of the curve. So I think, how about if I just say higher than today as opposed to lower?
Okay, that's fine. But no, don't want you to worry, but I'm gonna hold them to something. Number one, we're recording on December 2nd of 2024. Current 10 years at 4.19.
Right.
So Lane will
Yeah.
go with 4.2 as your Price is Right end of year 25 for the 10 years.
You know what?
4.2.
I'll get through my dart a little tighter. I'll talk 450, 450 or above.
4.5 on the 10 year a year from now.
Even though the Fed is easing, which is
All right,
a weird prediction to make.
let it be known.
Nobody
shall see.
watches my predictions anyways, right?
Well, thank you for your time, Lane, today. If you were a Goldman analyst, you'd probably have predicted like 8 or 9 just to get some eyeballs on the show.
Could be.
No, man.
Well, but 3 months from now, I could predict a completely different thing and nobody would hold me
That's
accountable.
true. You
Right?
get to revise it, yes, with a better prediction.
I get to revise.
Alrighty.
Oh, absolutely. Always. Lane Jones, thank you so much for joining us for episode
Thank you, gentlemen.
6 of
It's an
the
honor
Untitled Chart.
and a privilege.
Listener, thank you. Brett, always a pleasure.